In Canada, the decision of when to buy life insurance and which type depends heavily on your life stage, financial obligations, and future goals. There's no one-size-fits-all answer, but here's a breakdown by typical life stages and associated policies. 1. Young adult, 18 to 20s. When to buy. Now is ideal for future savings. Even without dependents, buying young means you lock in the lowest possible premiums for permanent policies. Your health is likely at its peak, resulting in the best rates. If you have co-signed debts, if parents or others have co-signed student loans, car loans, or even a first mortgage, a small policy can protect them from financial burden if something happens to you. Which policy and how? Term life, e.g., 10 or 20-year term. Affordable coverage for specific debts. Small permanent policy, e.g., whole life or universal life. While not immediately essential for all young adults, a small permanent policy bought now can be a powerful long-term savings tool due to tax-deferred cash value growth and guaranteed insurability. This is especially true if you anticipate future health concerns. How? Online quotes for simple term policies are available. For permanent policies, or if you have any health concerns, consult a licensed life insurance advisor. 2. Starting a family, newly married, 20s, 30s. When to buy? Immediately. This is often the most crucial time. You have dependents, spouse, children, who rely on your income. Buying a home. Life insurance can cover the mortgage, ensuring your family isn't burdened if you pass away. Which policy and how? Term life, e.g., 20 or 30-year term. Most common for this stage. It's cost-effective for covering large temporary financial obligations like a mortgage, childcare, and income replacement until children are independent. Joint first to die. Term. An option for couples to cover shared debts, though it pays out only once. Consider if one partner's income loss would severely impact shared financial obligations. Layering, laddering term policies. Consider buying multiple term policies of different lengths and amounts. For example, a larger 20-year term for peak income replacement and a smaller 10-year term to cover specific debts that will be paid off sooner. Consider a small permanent policy to cover final expenses and leave a small legacy, potentially with a critical illness rider for added protection. How? Work with a licensed advisor. They can help calculate your needs, income replacement, debt coverage, future education costs, and compare options from various insurers. 3. Mid-career, established family, 30s, 50s. When to buy? Regular review. As income increases, debts change, and children's needs evolve, e.g., post-secondary education, it's important to review and adjust coverage. Business owners. Crucial for protecting your business and ensuring its continuity if something happens to you. Which policy and how? Continue term life. Potentially renew existing term policies or purchase new ones as old terms expire. Premiums will be higher than when you were younger. Converting term to permanent. If your health has changed or you desire lifelong coverage, convert a portion of your term policy to permanent without new medical underwriting. Permanent life, whole life or universal life, becomes more appealing for estate planning, to cover potential capital gains taxes at death or ensure a tax-free inheritance. Wealth accumulation. Universal life policies in particular offer an investment component that grows tax-deferred. This can be a supplementary savings vehicle. Insured Retirement Plans, IRPs. For high net worth individuals, an IRP strategy using permanent life insurance can create a tax-efficient income stream in retirement. Joint last to die, permanent, ideal for estate planning, especially for couples with significant assets who want to leave a legacy or cover future tax liabilities. How? A financial advisor is crucial at this stage to integrate life insurance with your broader financial, investment, and estate plans. They can conduct a detailed needs analysis. 4. Approaching retirement, 50s plus. When to buy. Review existing coverage. Employer-provided group insurance often ceases or reduces significantly upon retirement. Review individual policies to ensure they align with post-retirement goals. Final expenses, even without dependents, covering funeral costs and final medical bills can prevent burdening your family. Legacy planning, to leave a specific amount to children, grandchildren, or charities. Which policy and how? Small permanent policy, for covering final expenses. Options like guaranteed acceptance life insurance, often for ages 50-75, offer coverage with no medical exam, though at higher premiums and with lower coverage limits. Term 100. While technically a term, it offers coverage for your entire life with guaranteed premiums. It functions like permanent insurance, but without the cash value component of whole life or universal life. Permanent life, whole life, or universal life. If you still have significant estate planning needs, desire wealth transfer, or are using an IRP strategy. Joint last to die. Permanent. Continues to be valuable for couples focused on estate planning. How? Consult a financial advisor specializing in retirement and estate planning. They can help you assess your need for ongoing coverage in light of reduced income, pensions, and other assets. General considerations for how to buy. Assess your needs. Income replacement. How many years of your income would your dependents need if you were gone? Debts. Mortgage, car loans, student loans, credit card balances, future expenses, children's education, wedding costs, elderly parent care, final expenses, funeral costs, probate fees, taxes, existing assets, pensions, savings, investments, other insurance. Use an online life insurance calculator or work with an advisor to get an estimate. Determine the type of coverage. Term. If your needs are temporary, e.g. until mortgage is paid off, children are grown. More affordable initially. Permanent. If your needs are lifelong, e.g. estate planning, covering final expenses, wealth accumulation. More expensive, but offers lifelong coverage and potential cash value. Choose the right amount, based on your needs assessment. Don't underestimate, but also don't over-insure and pay for unnecessary coverage. Shop around. Premiums and policy features vary significantly between Canadian insurers. Get quotes from multiple providers. An independent life insurance broker can do this for you efficiently. Be honest on your application. Disclose all health conditions, lifestyle habits, smoking, high-risk hobbies, and family medical history. Misrepresentation can lead to policy cancellation or denial of claims. Consider riders. Evaluate if optional riders, e.g., critical illness, disability waiver of premium, guaranteed insurability, child rider. Add value for your specific situation. Review regularly. Your life circumstances will change. Reevaluate your coverage every few years or after major life events, marriage, birth of a child, new mortgage, career change, divorce. The younger and healthier you are when you purchase life insurance, the lower your premiums will be. This makes starting early, even with a small policy, a financially savvy decision for most Canadians.